Hello traders, Gary Wagner here. It is 11:56 in Honolulu, 5:56 in New York on Thursday, 4th day of August, 2022, and this is the Daily Report for gold and silver. A combination of factors resulted in sharp increases in gold and silver pricing and sharp decline in the U.S. dollar, as well as yields on U.S. Treasuries. Gold, basis the most active December contract, is currently up $31.50. That's a net gain of 1.77%, and it is fixed at $1,807.90. Part of today's gain was directly attributable to heightened geopolitical risks, and that bid the precious yellow metal higher as a safe haven asset. But dollar weakness also played a major part in today's decline, and that was based on fears of a recession in the United States, with tomorrow's jobs report either confirming or denying that possibility. The dollar index declined by 0.70% and is currently fixed at 105.635. Lastly, silver was not left alone in the dark. That gained 1.12%, or a total of 24 cents, with September silver now at $20.13.5. With such strong fundamental events shaping the financial markets, we really need to take a close look at the dollar as well as gold on a technical basis. First, when we look at the dollar and we have a daily dollar index chart up, we can see that this final spike took the dollar index just above 109. From there, we've had a methodical decline in pricing. This is current pricing today. The dollar itself declined by about 0.7%. The first area we want to look at for potential support is going to be an area at around 105, which is both the 50-day moving average as well as 104.58 being the 23.6% Fibonacci retracement level. Those are the key areas we want to see, because if the dollar breaks through these areas, the next real logical level to look for dollar support comes in at 103.37 and then 101.74. That would be the area of major support. As long as the dollar continues to trade under pressure, we can expect that to dynamically support gold prices moving higher. Unquestionably, today's dramatic price increase in gold was significant on a technical basis. First, we can see that gold effectively traded and closed above $1,800 per ounce. We had been labeling that as a minor point of resistance, and it also closed well above the 50-day moving average, which is currently fixed at $1,792.20. So the question we need to ask ourselves, has the long correction that began in March at $2,077 and concluded in July at $1,678 concluded? And the only way we can look at that from a technical standpoint is to look at the series of lower highs that came in and lower lows. We had our first high, our benchmark high, at $2,077. The next high was lower at $2,002. Below that was $1,880, and that's the last real lower high we have seen. In terms of lower lows, as this market came down, we hit the first low at $1,890. We had this second low come in at approximately $1,770, and the final low at $1,678. So for us to get a real technical confirmation, we need to see gold trade to a higher high, which means that this current rally would have to conclude above the former lower high that came in at around 1880. That's quite a distance from current pricing. Traders, as you know, we were hoping that gold prices would soften a bit and fill this gap that occurred when August expired and December became the most active futures contract. The fact that we broke above this resistance line, the 50-day moving average, and $1,800 on a closing basis today confirms that our assumption of being able to go long gold between 1750 and 1775 was incorrect, and we will have to develop a new strategy for entry. The good news is, I believe that we have still a lot of room to the upside because, as I said, for us to just get confirmation, we would have to see gold go above $1,880, and that is about $70 from current pricing. We'll talk about that tomorrow, but we'll explore that in detail next week. This has been Gary Wagner, wishing you, as always, good trading. We will talk to you tomorrow for the weekly wrap-up and review. Bye-bye.